Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Hey, this is Stan the Annuity Man, and welcome to Fun with Annuities. What we're going to talk about today is a question that I'm getting so much, daily, from multiple people. How do interest rates affect annuities and different annuity types? With interest rates at supposed lows, people think that they're low, just because most of us remember Jimmy Carter years where you had CDs in the double digits, right? Remember that? But also your mortgage rates were in the double digits. So there was good and bad, but everyone is yearning for higher interest rates. And I do feel for the people out there that need interest rates to live on, meaning their CDs, if their CDs were better, they'd be living better, eating better. It is kind of sad where it is right now. But with that being said, and I've been in this annuity thing, and the financial services business. I was with Dean Witter, Morgan Stanley, Payne Weber, UBS for a long time when I was out of college until now. I've been in the financial services industry. What I do know is you can't predict interest rates. Nobody can, even though there's people that say that they can. And number two, this might be the new normal. I know that's hard to believe because people say, well, interest rates are low. And my question is, and it's really, I'm not trying to be smart, like a smart A about this, but low compared to what? When you say it's low, and the bogey that we're all looking at in the annuity world, and probably you two outside in the investor world, is the United States 10-year Treasury Note, whatever that U.S. 10-year Treasury is. And people say, well, standard rates are low. Compared to what? When you look at the 10-year Treasury equivalent in other countries, Japan and Germany, some of those countries have negative equivalents, meaning you have to pay them to keep your money. So right now, the United States 10-year Treasury is still the highest when compared to other countries. So, people say, well, it's interest rates are low. Compared to what? No, actually, we're the highest. So this might be normal. It might be the way it is for the rest of our lives. Our children might not see really high interest rate. This might be where it's at because, the stock market's kind of driving the train and driving the news cycle, and it's just hard to predict what the Fed's going to do. So with that being said, how do you, as an annuity buyer or someone that's interested in doing more research in annuities and finding out if it's the right thing for you to do, how do you go about doing that? How does it affect specific types? So what we're going to do is go through every type of annuity that's out there, and I'll tell you how interest rates affect it, whether it affects it a lot or affects it some. Obviously, interest rates play a role in all annuities, but sometimes it's a primary role, and then sometimes it's a secondary role. Most people think it's primary. Most people think that interest rates drive every train with annuities. No. That's not true. At the end of the day, you're buying a contract. At the end of the day, it's all math. At the end of the day, you have to be satisfied with the contractual guarantee that you shop for. And you can't time rates. Please don't try. I'd rather you try nailing Jell-O to the wall or putting a Jell-O roof on your house. It'd be more fruitful because no one can time it. The best you can do in the annuity world to combat the movement of interest rates is to ladder the purchase or ladder the start date, just because you just don't know, what's going to happen. Just here recently, I thought interest rates, would be going up. That was my guess, and it was nothing more than a guess. But of course, all of us were wrong guessing that. They actually went down. So you're like, okay, I don't guess and predict and tell my clients to do things based upon my guessing and predict. That was a personal guess. I thought, yeah, I think they might take it up here. No, they didn't. They actually lowered it, which says none of us can predict it. So let's go through each specific type and talk about how it affects each specific type of annuity. First of all, let's talk about single premium immediate annuities. Just a quick elevator speech on each of these. Immediate annuities are the granddaddy of all annuities. They're the pension annuities, income starting within 30 days of the policy being issued up to as far out as 13 months. So it's an income now type quote. Immediate annuities are an annuitize. Annuitization means creating payments. It's in that payment stream is a combination of return of principal plus interest. So that interest part, it is affected by that. But with immediate annuities, the primary pricing mechanism is your life expectancy, or if you're setting up joint with someone, life expectancies, plural, at the time you take the payment. It's a transfer of risk bet that you're going to live longer than the annuity company thinks you're going to live. And if you do live longer than that, they are on the hook to pay you regardless of how long you live. Rates do play a role, but it's secondary. All right? And interest rates would really have to move significantly to move the needle because the life expectancy drives the train. Okay? So let's go to deferred income annuities. Just in a recap, deferred income annuity is also called a longevity annuity. It is the cousin or sister or brother of the immediate annuity, because with a deferred income annuity, with an immediate annuity, income starts as soon as 30 days from the policy being issued and up to 13 months. With a deferred income annuity, if you defer past 13 months and farther out than that, it's a deferred income annuity. It's the same structure, very simplistic, no market attachments, no moving parts, no annual fees. But it's the same annuitized structure where you're getting payments for life. You can set up joint, you can set it up, single life, whatever you want to do. But once again, the driving pricing mechanism, what drives that train, is life expectancy at the time you take the payment. Do interest rates play a role? Absolutely, but it's secondary. It's not a primary factor in the pricing of a deferred income annuity. So a deferred income annuity is a future pension product primarily based on your life expectancy, and you're transferring that risk to the annuity company to pay you for the rest of your life, if the joint rest of your lives, regardless of how long each of you live. But interest rates do play a role because the income stream is a combination of return of principal plus interest. So secondary, it's a secondary pricing mechanism. Let's talk about QLACs, qualified longevity annuity contracts, which are DIAs. It's a deferred income annuity, but you can only use a qualified longevity annuity contract, QLAC, inside of a traditional IRA. For most cases, they're trying to put them inside of 401ks, et cetera. But in traditional IRAs, that's where the vast majority of people buy QLACs. Once again, just like a deferred income annuity, the driving pricing mechanism on it, what drives the train, is life expectancy at the time you take the payment. Interest rates play a secondary role. Obviously, if they move way up, it will affect it some, but they'd have to move way, way up for it to. So people that are, when there's a 25 basis point move either way, it really doesn't move the needle. 25 basis points is 0.25%. Basis points is kind of what's used in the financial world. But in English, that's 25% of 1%. So if that's the movement of the interest rates, it really doesn't move the needle because life expectancy drives the train. So with SPIAs and DIAs and QLACs, single premium immediate annuities, deferred income annuities, and qualified longevity annuity contracts, life expectancy is the primary pricing mechanism. Interest rates are secondary. Now, let's talk about multi-year guarantee annuities, which are MYGAs, multi-year guarantee annuities, also called fixed rate annuities. Remember, and I've done a podcast on this as well, but multi-year guarantee annuities are the annuity industry's version of a CD. So a CD pays you an interest rate annually for a specific period of time that you choose. A multi-year guarantee annuity is a fixed rate annuity where it pays you a specific interest rate for a specific period of time that you choose. Same thing. The difference between a MYGA and a CD, a multi-year guarantee annuity, and a CD is that in a non-IRA account, with a CD, you have to pay taxes on the interest every year. With a multi-year guarantee annuity in a non-IRA account, the interest compounds tax deferred. Doesn't make it better. That's just the rule. And typically with CDs, they offer the highest rates between 1 to 3 years. From 3 years to 5 years, it's a MYGA. So multi-year guarantee annuities are very, very competitive and typically offer the highest fixed rate when compared to CDs 3 years and out. But just like a CD, multi-year guarantee annuity, they are solely affected 100% by interest rates because they're not a lifetime income product. You're not annuitizing it. You're controlling the asset, you're protecting the principal, and you're only getting the interest rate that is guaranteed within the contract for the specific period of time that you choose. On my site at theannuityman.com, we list the best fixed rates for your state because each state fixed annuities are regulated at the state level and approved at each state level. So when you go to our site, the site theannuityman.com, and click the MIGA feed, you'll be able to filter your state and then duration you're looking at, and it'll list what's approved in your state. But 100% affected by interest rates, just like CDs are 100% affected by interest rates. If you want to go shop for CDs, the best place, in my opinion, is bankrate.com. I have no affiliation with them other than if you use bankrate.com to shop for your CDs and you use theannuityman.com to shop for your MIGAs, you're going to see the best rates in the country, period. And you'll be able to ladder and buy the ones that you want to buy. But yeah, MIGAs are 100% affected by interest rates. So it is a barometer. Interestingly enough, and people always ask me, Stan, when the interest rate changes, do companies just react immediately? And I'm like, no, not really. I call it like the middle school dance. You remember the middle school dance where the boys were standing on one side and the girls were standing on the other, and we're just waiting for some person, some future CEO with guts, right? The person that went out there and danced was probably a CEO somewhere to break the ice. It's kind of like back in the day with all of us old people remember jumping rope, and you had two kids turning the rope and then one trying to jump in and time it right, I guess. Annuity companies kind of wait on each other to react because they're commodity products. In the MIGA world, typically when rates go up, people move slowly, carriers move slowly. And when rates go down, they move a little faster. That might not be really true if you just did a historical look into it, but that's just my opinion and me watching it for decades and being one of the top MIGA people out here that sells those simplistic CD type products. But MIGAs, yes, certainly are affected 100% by interest rates. Let's talk about indexed annuities. Indexed annuities and interest rates, it's a couple things. Number one, indexed annuities are the gains, supposed gains, hopeful gains, potential gains are tied to an index option, typically the S&P, not including dividends. And those are locked in typically with most of the annuities from contract anniversary date to contract anniversary date. There's over 700 index option choices, so I'm not going to go into all 700, but that's just the 30,000-foot view of kind of how they work. Do interest rates play a role? Yes. And I guess it's semi-primary in my opinion, because the caps and the spreads, and those are the limitations that are placed on the index options, not to get in the weeds here, but trying to show paintings to blind people, right? No offense to blind people, is when interest rates are a little bit higher, then the caps, the limitations on the upside that you can lock in, and the spreads are more favorable to the consumer. So the lower the rates, then the lower the caps, and the less favorable the spreads, et cetera. So indexed annuities are affected by low interest rates. But the argument kind of when I said semi or kind of, because the S&P, let's just use the S&P index as S&P 500 index as one of the indexes that they use, and that's primarily the one that all of them use. If interest rates are low, then markets typically go up, right? So I think it somewhat offsets each other with indexed annuities, but understand indexed annuities are CD products. They were designed and introduced in 1995 for CD returns, enhanced CDs. That's really what they are. They're not market products. You don't have to have a securities license to sell them, which should tell you everything you need to know. You only need a life insurance license, and if you really work hard at it, you can take the crash course, pass it in a week, and start selling the next week. That's not a very high bar, but that's the way it is. So indexed annuities are affected by interest rates, but they also benefit from low interest rates affecting the index options, hopefully going a little bit higher. So let's move to the next one. Variable annuities. Variable annuities are really, the inside of a variable annuity, which are the separate accounts. Well, me and you call them mutual funds, but in the variable annuity industry, they call them separate accounts, But these mutual funds are affected by interest rates just like regular mutual funds are. It depends on what the mutual fund's underlying strategy is. But where variable annuities and index annuities can also be affected by interest rates are the attached benefit income riders. So with an income rider, if interest rates are higher, the monopoly money percentage that the income benefit grows by could be a little bit higher if interest rates are higher. That doesn't mean you're getting a higher yield. What that means is that your income account is growing by a higher percentage of which you can calculate your first income payment. That's how income riders work. So you're not getting a 5 or 6 or 7% yield. Yield means you can get to the money, you can peel off interest, you can cash it in. What you're getting is a growth on that income benefit asset so that you can calculate exactly what the income stream is going to be in the future, because it's going to grow by a contractual percentage, monopoly money percentage, that you can use to calculate your first income payment. So interest rates do affect the income riders as well. So to kind of go over all of them, the immediate annuities, the deferred income annuities, and the QLACs, interest rates are a secondary pricing mechanism. Life expectancy kind of drives the train because those are lifetime income guarantees. Caveat to that would be if you're buying a period certain immediate annuity or a period certain deferred income annuity, then interest rates play the primary role because there's no lifetime income guarantee transfer of risk. So that's the caveat. So if you're saying I need a 10-year period certain, then it is about interest rates. If you're saying, Stan, I need a lifetime income stream with a 10-year period certain, then it's not about interest rates primarily, it's about life expectancy. I know we're kind of getting caught in the weeds there, but like any industry, it can get as complex as you want to. So that's when people say, I hate annuities, or all annuities are this, or all annuities are bad. That's crazy. And it's misinformed and uneducated, and you know better than that. When you hear that stuff, that's similar to turning on a specific news channel and believing everything you hear from that news channel, whatever side of the ledger you're on. So, the interest rate world is interesting because, eventually, I guess it does have to move up. I was telling someone the other day, of all the economic classes that I took in college, and this person was very well educated that he took in college, I was saying, none of that's applying somehow. Somehow, all of the economic data and the interest rate supposed movements based on that economic data doesn't seem to be correlating anymore. So all bets are off. I guess we're in blue water here that nobody really knows. And the tick data going backwards doesn't really count because the tick data going way back didn't include a 24/7, 365 global internet attached markets where everything's trading real time. So I really don't know. I feel for people that really need to live off interest rates. And if they were higher, then even the products that are affected, secondarily, the lifetime income type products, those guarantees would be higher as well. And it wouldn't be a tons higher, but it could be depending on the rate movement. So I tell people all the time, if you, instead of trying to time interest rates and getting all caught up in it and, trying to do research on when they're going to move, that's crazy. You're not going to figure that out. Nobody is. The best bet is to ladder the purchase. Like, for instance, on MYGAs, fixed rate annuities, you just ladder them in different durations. Like you do a 3-year and a 4-year and a 5-year ladder and have money coming due in case rates move. Obviously, that could work against you if rates go down, but that's your only shot, in my opinion. So laddering is the only way to look at it if you're trying to time it. Also understand that all annuity types, SPIAs, DIAs, MYGAs, QLACs, immediate annuities, variable annuities, these are commoditized quotes, in my opinion. If you're buying them for the contractual guarantees, which you should be quoting as many carriers as humanly possible, which we do, looking for the contractual guarantees that fit your specific situation. Annuities are not one size fits all. You have to, all the time, shop and don't allow people just to show you 1 or 2 carriers. Make them show you 5. Make them go out there and work to show you as many quotes as humanly possible. On our MYGA feed at theannuityman.com, you'll see tons, depending on the duration of MYGAs out there. With our immediate annuity income now quotes, we'll show you 10 or more of the top, in order of the top contractual guarantees. For our income later, we do the same thing. For our Creolite, we do the same thing. We go into all quotes not knowing who's going to finish first. And, then we have the discussion on claim expandability. Is this the right company? Do you feel comfortable with it? Do you like the guarantee, et cetera? But you have to be satisfied with the guarantees. And regardless of interest rates, it really comes down to, once again, two things. PIL, which is principal protection, income for life, legacy, and long-term care, confinement care. If you don't need to solve for one of those four things, you probably don't even need an annuity. If you need market growth, you probably need just to stay in the market, so you have an infinite amount of choices, because any annuity that says they can provide market growth, you're limited. There's some big time limitations with those products. So just stay in the market if you need market growth. And then the other thing is the two questions to determine what type of annuity is. What do you want the money to contractually do, and when do you want those contractual guarantees to happen? From those two answers, then we can pinpoint exactly the type of annuity that you need or that you might need, and then we quote it, and then we start the process of talking about the limitations and the benefits. So in summary about interest rates, how do they affect it? They affect all annuities, but they affect all annuities differently. Depending if it's a lifetime income stream annuity, it's a secondary pricing mechanism. If it's a fixed rate annuity, or it's going to affect it 100%. And with variable and index with income riders, it's going to affect it on one side good and the other side maybe not so good. So there's no perfect answer. There's no perfect product. There's just a bunch of bad sales pitches out there, as you know. So be careful, do your homework, and continue to tune into this podcast, because I'm going to keep digging down into every single aspect of annuities, good and bad, and strategies, etc. So with that, my name is Stan, the Annuity Man, and you have been listening to Fun with Annuities. See you next time. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.